The S&P ASX 200 closed Friday down more than 2% for the week, its fourth consecutive losing session. Miners slumped. Gold stocks cratered 2.5% in a single session. The All Ordinaries Gold Index gave back gains that had taken weeks to build. Energy and utilities were the only sectors that ended higher, lifted by Brent crude pushing back above US $106 per barrel on renewed fears over Middle East supply disruptions. It was a week shaped by competing forces pulling in opposite directions. Oil above $106 is normally a tailwind for energy names, and it was, with Woodside shares extending their remarkable 40% rise since January. The iron ore side of the ledger was messier. Fortescue reported record 9-month shipments of 148.7 million tons, and yet shares fell 5% on the day. The quarterly miss on a single metric, 48.4 million tons versus the 49 million the market expected, was enough to overshadow everything else. Lithium moved differently. Pilbara Minerals surged nearly 4% after posting a 61% jump in realized spodumene prices and a 178% surge in quarterly cash margins. IGO collapsed 15% in the same session. The divergence between two battery materials companies on the same day in the same sector told you something about how specific and unforgiving this market had become. But none of that, not the oil premium, not the iron ore miss, not the lithium split, was the defining story of the week. A $319 stock was trading at $91 by Friday. Cochlear Limited fell nearly 45% in 3 trading sessions after the hearing implant maker issued one of the most severe earnings downgrades the ASX has seen from a large-cap healthcare name in years. The company said it now expected underlying net profit of $290 to $300 million, down from a prior forecast of $435 to $460 million. That is not a guidance trim. That is a 35% cut to the profit range's midpoint, delivered mid-cycle. The reasons Cochlear gave were multiple and overlapping: hospital capacity constraints in Western Europe, growing surgical waiting lists in the UK and Germany, industrial action in Italy and Spain restricting surgical throughput, a slowdown in US volumes that emerged in March after tracking in line with expectations through February, and sitting over all of it, consumer sentiment in key markets hitting historic lows, and according to the company, beginning to affect discretionary healthcare decisions in the adults and senior segment. That last point is the one that stopped analysts. Cochlear implants are not cosmetic procedures. They are a medical necessity for profound hearing loss. The idea that consumer sentiment, typically a retail and travel phenomenon, was now delaying implant surgeries was not something the market had modeled. It raised a harder question. If sentiment is keeping people out of surgical queues, how long does that queue actually get, and when does it start clearing? Macquarie cut its price target from $239 to $115. Jarden reduced theirs from $224 to $169. Both retained neutral ratings. Both acknowledged the shares look cheap, yet their 12-month price targets sit 47% apart, a gap that is not a rounding difference. It is a disagreement about whether Cochlear's structural growth story is intact or has been fundamentally disrupted by pricing competition and a permanently altered demand curve. Jarden flagged the competitive angle directly, noting the company appeared to be losing market share to rivals on price. That is a different problem from hospital backlogs. Backlogs clear, competitive share losses stickier. The history here is instructive. When dominant medical device companies suffer earnings shocks of this magnitude, ResMed in 2023 on GLP-1 fears, CSL in 2020 on plasma collection disruptions, the typical pattern is a sharp initial overshoot to the downside, followed by a slow recovery as the market resets its baseline. In those cases, the floor held when the underlying demand thesis remained intact. The question for Cochlear is whether the demand thesis is intact or whether something more structural has changed in how surgeons, hospitals, and patients are making decisions.
The $169 Jarden target assumes the waiting list dynamic is temporary, that once hospital capacity normalizes in Europe and sentiment stabilizes in the US, volumes recover and the company gets back towards its prior margin trajectory. It also implicitly assumes that competitive pricing pressure is manageable, not existential. If those conditions hold, Cochlear at $92 is priced for a worst case that does not arrive. The $115 Macquarie target assumes something harder, that recovery to the prior 18% net profit margin takes years, that competitive share loss compounds, and that the demand slowdown in the adult and senior segment proves persistent rather than transient. Under that view, $92 is not cheap. It is fair value for a business with diminished earnings power and limited near-term visibility. Management acknowledged the company had no clear line of sight on when conditions would improve. That honesty is notable. It means the next catalyst is not internal, it is external. Watch for surgical volume data from European hospital systems and U.S. consumer sentiment readings through the June quarter. If volumes start recovering in Western Europe by mid-year and U.S. softness stabilizes rather than deepens, the $169 scenario has a path. If U.S. volumes deteriorate further into Q4 or competitive pricing in Asia accelerates, the $115 case becomes the anchor. The current evidence tilts towards patience over conviction. Cochlear remains the only ASX-listed company with dominant global share in cochlear implants. That position does not disappear, but the pace at which earnings recover will depend heavily on factors the company cannot directly control: hospital funding decisions and government health systems, consumer confidence and discretionary medical spending, and how aggressively competitors push on price in markets where Cochlear was previously the only credible option. At $92, the stock is pricing in prolonged pain. Whether that proves to be accurate will become clearer when the full-year result lands. The real test is not whether Cochlear can recover. It almost certainly can. The test is how many years that takes. And right now, even the brokers who have spent weeks rebuilding their models cannot agree on the answer.